Hi friends, good evening. Welcome once again. So today's conversation is about the recent developments as far as the measures initiated by RBI. So this is something which our RBI governor made a detailed presentation, and there were a lot of technical jargons involved, a lot of technical measures which he said would effectively lead to 3.75 lakh crores being available in the market. So the conversation today would be to actually try and break down from a practical standpoint as to what these measures are and how it is likely to affect uh, the population. So with this, thanking Subhash, Gracelyn and Sundar for their efforts to get this done. So these are some of the terms which we would be seeing, friends. So CRR is cash reserve ratio, IFSC, International Financial Services Center, SLR, statutory liquidity ratio, LTRO, long-term repo operations, LAF, liquidity adjustment facility, MSF is marginal standing facility, M4 is broad money. We'll understand practically what broad money is all about. FIMMDA is fixed income money market and derivatives association, and IBU is IFSC's banking unit. Moving on, this is the agenda for the day. We shall try and understand the measures from the liquidity perspective, regulatory and supervision initiatives, and of course from the financial market perspective. Let's quickly move on to liquidity measures. So under the long-term repo operations, the LTRO, so the RBI provides a long-term, which is 1 to 3 year loans to banks at a prevailing repo rate. You must understand that the repo rate has also been reduced by 0.75%. Since banks are able to get long-term funds at a fairly cheap price, which are exclusively to be used for investment purposes. When they say investment, it is for the purpose of onward lending. To companies with good standing will now have access to bank financing at a much more competitive term, because RBI is giving these loans to the banks, and obviously this is going to expand the credit flow into the economy. So what the current proposal is, the RBI would conduct auctions of targeted term repos of up to 3 years. So let's say Bank of India wants a 10,000 crore 3 year line. So likewise, every institution will put their demand for various lines. So for a total amount of 100,000 crores, 1 lakh crores at a floating rate. So that's the overall window given, linked to the policy repo rate. So whatever is the rates prescribed. So repo is a rate at which institutions can borrow, banks can borrow from RBI, and reverse repo is the other way around. When RBI borrows from these institutions, or when these institutions park funds with RBI, whatever is the rate, what they would pay is the reverse repo rate. So the first auction was conducted on 28th of March, and the amount fixed by RBI was 25,000 crores. But technically, they've received bids for about 2.8 times that number. So which effectively shows the demand for credit. So the liquidity availed under the scheme by banks has to be deployed in investment grade corporate bonds, commercial paper, and non-convertible debentures. So we are talking about rated institutions to whom these funds would be deployed. So RBI has now expanded the credit available. The overall window is 1 lakh crore. The first lot was 25,000 crore. So that would trickle down into the economy through various channels. And similarly, as per RBI guidelines, the non-SLR investment grade bonds are those bonds which have been assigned an investment grade by a credit rating agency, and the investment grade prescribed by CRISIL varies from BBB to AAA, and these would be revised every year. Now, what effectively this impact is going to do, the LTR or the long-term repo operations, is this would reduce the cost of borrowings and would also increase the flow of credit. And the annual growth rate of investment by banks in such assets has been on the lower side. So the current proposal would definitely augment this growth rate. So we're talking about monies flowing to, of course, rated instruments. From there, it has to gradually percolate to the lowest levels of the society. Next, flow of financial resources from scheduled banks to the commercial sector. So what we saw as a first phase, So now we are going to look at the second phase. So you have the apex banker who is now lending funds to the institution, made it available to them. Now these institutions would now have to make these funds available at the banker level, at the commercial entity level. So the credit flow from scheduled commercial banks to the commercial sector, which is a business sector, can happen in two formats. One is through the non-food bank credit. So this constitutes the financial resources given to people other than the FCI. FCI is the Food Corporation of India. And the other option is through non-SLR investments. Again, this constitutes investments in commercial papers and shares or debentures, which do not qualify to be eligible instruments for maintaining SLR. So SLR is the statutory liquidity ratio. A percentage of their advances and deposits is supposed to be maintained with the central bank as CRR, SLR, and all, for various purposes, just to ensure that risk capital is available in the event of any untoward or eventuality. So this would give you a good perspective on how the flow of credit has happened. If you see the non-food bank credit, it's been hovering, it's come down from 14% to about 7%. These are the annual growth rates. And what is the non-SLR investments technically has not grown at all. It's been maintained at the same level. And the non-food bank credit has come down. The growth rate has come down again from 14 to 7%. So which effectively means that the growth in credit itself has come down. And that clearly reflects what's been stated both in the budget and the RBI's monetary policy publications time and again. Sorry. Yes. So how are these non-SLR investments, what this basket looks at? If you notice, by and large, the investments are in bonds or debentures. That's to the tune of 3.5 lakh crores as we speak now. And investments in shares, which is about 0.76, and investment in commercial paper, which are again debt instruments, is to the tune of 1.3 lakh crores. So the overall composition, so there has been a marginal shrinkage in the overall basket of non-SLR investments. So to this extent, the funds available via debt instruments or capital instruments has shrunk. So from, if you notice from, it has increased from 3.5 lakh crore, it's gone up to 5.5 lakh crores. But what is interesting is it has come down from December 19. December 19, the investment in bonds was to the tune of 5.6. It's come down to 5.4. Whereas the overall basket of other instruments together was 1.7, which is now about 1.8 or 1.9. So there has been a marginal shrinkage of 0.1 to 0.2. That again clearly reflects the scenario where we are at this point in time. So what is the expectation from this 3-year targeted LTRO? This is what happened on 27th of March as our RBI governor was making this announcement. He said on 27th of March we would be doing an auction. At that time, so he auctioned 25,000 crores worth of 3-year paper, and the total bids received were to the tune of 60,500 crores, which clearly shows the demand in the market. And the amount allotted was 25,009 crores. So the allotment ratio is about 41%. So he's received bids to the tune of 2.5 times, which is definitely healthy. Because when someone is saying, I want to give lines to the banks for onward lending, which effectively means, and the banks have come forward for a much larger exposure than what was allotted, which typically means that there is good demand for these instruments at the base level. Next, CRR. So cash reserve ratio is a minimum fraction of the total deposits of customers, which commercial banks have to hold as reserves in cash or deposits with the central bank. So let's say SBI has 10 lakh crores of deposits, and the CRR rate is 4%. 40,000 crores have to be maintained with the institution. As on 13th of March, this cash balance of scheduled commercial banks, excluding the regional rural banks, with RBI was about 5.5 lakh crores, and with an average daily cash reserve requirement of 5.4 lakh crores. Now, typically we're talking about 5.5 lakh crores being parked, which constitutes 4% of the CRR. So you were to extrapolate, so 25 times this number is the total amount of deposit which the institutions have taken from customers. Now what has happened, they have brought down this requirement from 4% to 3%, which effectively means these institutions will now have an excess of 1.36 lakh crores. So they no longer need to keep 5.5 lakh crores. It's good enough if they maintain for this level 4.15 lakh crores. That's the sum and substance. So this excess 1.36 lakh crore is going to come into the market, and that's straight liquidity apart from that 25,000 crores. So the fact that these institutions have bid for 61,000 crores even after this CRR reduction also states that there is capacity to absorb this 1.36 lakh crores as well. And if you notice historically, the actual balance vis-a-vis the average cash reserve requirement, these two have more or less been equal, more or less throughout. Now, what is the effect of reduction in CRR? So in this case, we need to understand before we get into the concept of broad money. So broad money is a measure of money or money supply in an economy, including both highly liquid narrow money or less liquid forms. So during the year, you would see that in 2012-13, a series of reductions in CRR, so where it went down from 6% to 4.75%. was made by RBI to increase liquidity in the economy. You can see the graph on the left-hand side. Consequent to which, there was a huge supply of broad money, and it could be seen from the figure that the CRR has an inverse relationship with broad money, obviously, because when this comes down, that goes up. So except for the current reduction in CRR from 4 to 3, the CRR was literally untouched from 4.25, maybe 1.25 reduction since March 2013. So therefore, the government felt COVID-19 is one instance where there is a requirement for added liquidity. A liquidity adjustment facility, again, this is another tool to widen the monetary policy rate corridor, is used in a monetary policy that allows banks to borrow money through repurchase agreements, repos as we call it, or for banks to make loans to RBI through reverse repo agreements. So typically the arrangement between banks and RBI is whenever banks have surplus funds over and above what they are supposed to park or what they have demand for, they send it to RBI, and when there is a shortfall, they borrow from RBI. So when they borrow from RBI, we call it as repo rate. The rate so RBI charges at this point in time 4% for doing this, but for keeping your funds with RBI, let's say you keep an FD with RBI, the rate which RBI pays is what you call as the reverse repo rate, repo and reverse repo rates. So let's try and understand. So the gap between the repo and the reverse repo rate originally was at 25 basis points, with reverse repo pegged lower than the policy repo rate. Obviously, it's like your exchange rate, right? The difference between buying and selling rate of dollar vis-a-vis rupee. Now, let's assume banks can borrow from RBI at 4% and they can lend to RBI at 3.5 or 3.75%. So the difference between borrowal and lending is not too much. But the more higher the difference, meaning let's say you can borrow at 4%, but when you lend to RBI, you only lend at 3.25%. There is a significant disincentive to lend to RBI. And the higher this gap, higher is your disincentive. So consequent to the current scenario, what they have done, they have increased the gap between repo and reverse repo rate by 90 bips, which is almost 0.9%. And by increasing this gap, banks are now significantly discouraged to keep funds with RBI. And when banks are not able to keep funds, they don't feel comfortable keeping funds with RBI. What is the alternative for them? They only have to focus on lending it in the market. So this is another way by which RBI is significantly disincentivizing institutions from staying cash positive by putting the money in RBI, because the yields they are going to get from RBI are now significantly exaggerated in the negative side. So this is a good peak on M4 is your broad money, which is this money supply, and that keeps growing. Growth in money supply. And CRR rates, you would notice at 4% consistently over since June 14. Reverse repo rate is at 5%, and repo rate is at 5%, the orange, and reverse repo is marginally below that 5%. So the gap between the two is not significant. But imagine one is at 5 now today, the one is at 4 today, the other will be at 3.1%. So huge spread or a huge disincentive to stay cash positive or keep the funds with RBI. So what is this marginal standing facility scheme? So this is a scheme which was introduced in 2011, where scheduled banks could borrow overnight up to 1% of their net demand and time deposits, time liabilities. So what is this demand and time liability? The balance in your current account and savings account is called as demand deposits. Time liabilities are your fixed deposits, because there is a finite time frame within which this money has to be brought in. So this limit of 1% in marginal standing facility was increased to 2% in April 2012. So the funds will be borrowed under the facility against the bank's SLR holdings. So it's again a percentage. We saw how the SLR instruments are being parked. Now all SLR eligible transferable Government of India dated securities, treasury bills, and state developmental loans are eligible securities for the purpose of this marginal standing facility, because that's where you create liquidity or you make these securities a pledge for the banks to raise liquidity under marginal standing facility. So the interest rates of funds availed under this facility will be pegged higher than the prevailing policy repo rate, because apart from what they borrow from RBI, this is a facility which they are able to do on an overnight basis. So this would be more like, you can call it as an ad hoc OD for banks, so based on their daily requirements. So this would the cost of this would be marginally higher, and it would be entirely on the basis of the collateral of their SLR holdings. Now what RBI has done, they have expanded this threshold from 2% to an additional 3%. So, and this will be available only up to 30th of June. So up to 30th of June 2020, they can expand, all the scheduled banks can expand their ad hoc OD, you might call it. And this has been decided to increase the accommodation under the MSF from 2 to 3% with immediate effect. And there would be a general waiver for SLR falling below the minimum requirement to the extent of 3%. So even if your SLR comes down up to 3%, you are covered by virtue of this MSF facility. So the above measures together, the long-term repo, the CRR reduction, and the MSF expansion, is likely to inject a sum of 3.75 lakh crores into the system. So that's the expectation, friends, going forward. So which is why you would see in all the newspapers as to RBI injects. So how they inject, this is how it is going to happen. So this will give you a perspective on how this has panned out. So the MSF borrowing, so that fluctuates. And if you see the MSF rate, that's been coming down, obviously, because the RBI's repo rate has also been coming down. So the MSF rate will also come down. So this has been coming down consistently from about nearly 7% in December 18 to a tad under 6% at this point in time. Definitely, it will be another 0.75% lesser as we speak. And the MSF quantum also. So whenever we've had a bad credit offtake, so the MSF requirements will also be coming down. And this is erratic consequent to this particular phenomenon which we have been experiencing thanks to the NBFC crisis and all these. So regulation and supervision. So capital conservation buffer. So a lot of regulations with as far as banks are concerned are targeted at maintaining, protecting depositor interest and strength of the banks, thereby protecting the entire ecosystem. So let's try and understand what are the benefits which RBI has now tried to bring in as far as the regulations are concerned. One, what we saw was making sure physical cash is available for lenders, so that the institutions are well funded. The second, what we are talking about is the regulatory measures which helps them to postpone some of their regulatory commitments. What are those? So the capital conservation buffer was introduced by Basel III committee to ensure that banks have an additional layer of usable capital that can be drawn when losses are incurred. So one of the largest problem which we are facing throughout is capitalization. So there was a study by Mr. Arvind Subramaniam, which is a paper which we also did as a discussion, had a discussion on, where I believe out of 54 institutions, banking institutions in India, almost 28, more than half, their extent of capital is lower than the amount of NPAs. So this capital conservation buffer was supposed to be, as the name itself suggests, is a buffer which eventually will get created over a period of time as an additional layer. So it must be met with common equity tier 1 capital from owners' funds only. And this can be drawn only when the bank has a systemic stress, when the bank's financials are not doing the way it needs to be, consequent to a systemic stress, which is what we are currently facing. So 2.5% of the total risk-weighted assets was supposed to be kept aside as capital conservation buffer, which over a period of time, over a tranche of 4 years, it was supposed to be done. It was supposed to be made in tranches of 0.625% over a period, and the transition to full CCB of 2.5% was set to be completed by March 19, which is last year. Thanks to the crisis what we had, this was pushed over by one more year, and now it's further been pushed over from March 31st to September 30th, 2020. So there's an additional 6 months given. So the institutions don't need to spare their capital towards creating this reserve, because for this reason, because currently the need for this capital is elsewhere. Similarly, net stable funding ratio. Now, again, this is again one of the Basel Committee's reforms to promote a more stronger banking sector, and is defined as the amount of available stable funding relative to the amount of required stable funding. And this ratio should at least be 100% on an ongoing basis. So technically, the amount of money what you have as an institution should at least be equal to the amount of money which you require for this purpose. And it is expected to be 100%. A sustainable funding structure is intended to reduce the likelihood that disruption to banks' regular sources of funding will erode its liquidity position. Classic case was DHFL. To give you an example, there was a DHFL had an average maturity tenure between 8 to 10 years of their loans, whereas when I say loans, on their loans given, whereas they were borrowing on 30, 60 and 90-day papers significantly, because that was far cheaper than long-term commitments. So here every 60 days or 90 days, these institutions had to do a rollover. So, and whenever something of this sort, when a financial crisis happens, their ability to roll over becomes very difficult, and consequently they become bad loans, and the system needs to bail out these institutions. So this NSFR, the net stable funding ratio, was introduced to ensure that such risk of failure and systemic stress at a broader level are prevented. So that was one of the objectives with which this was introduced. Now, this available stable funding, what they say, is defined as a portion of capital and liabilities expected to be reliable over the time horizon considered by NSFR, which extend to 1 year. Now, what they have done now, this was supposed to be in place effective 1st of April, where whatever is the required funding and your available funding for the next 1 year should be in place. That's perfectly fine in a normal atmosphere, but given where we are now, the government has pushed this implementation again by 6 months. This will also be effective only from 1st of October 2020. What are the other regulatory measures they have taken? Something which is very popular now. All banks and NBFCs, again look at it friends, are permitted to give a moratorium. It is not mandatory. So what the RBI is going to say, RBI says is it's not that every institution have to give a three-month moratorium, but they say you can, if subject to your board approval, you can give a 3-month deferment. They can also give a deferment of paying interest on working capital limits, but this entire interest should be collected immediately upon the end of 3 months. And they've also included credit cards in this space. So all these are only recommendatory frameworks, because RBI cannot infringe into individual credit policies. But from what we are given to understand, interacting with decision makers at various banks and NBFCs, is the fact that the benefit of extension of 3 months of repayment would be made available to all standard accounts, which is non-NPA accounts at this point in time, and it's only going to be made optional to borrowers. Financial markets. So, permitting banks to deal in offshore non-deliverable rupee derivative markets. Okay, let's try and understand what this is. See, the name itself runs for 1.5 lines. So, a non-deliverable derivative contract on NDDC, as we call it, is a foreign exchange derivative contract involving the rupee entered into with a person not resident in India and which is settled without involving the delivery of rupee. So the contract does not involve a physical exchange of rupees, so your local currency does not go erratic, as rupee is not deliverable offshore, and it allows counterparties to settle their losses or profits in a convertible currency, possibly the US dollar, which is why it's what we call as a non-deliverable rupee derivative instrument. The rupee has been significantly volatile, where it touched the lows of 76 last week. Sometime in the month of March, last week of March. And the RBI had constituted a task force to look into the issues and recommend an appropriate policy structure in this regard. And one of the key recommendations was to enable rupee derivatives, which will be settled in foreign currency and which will be traded in the International Financial Services Commission in India. So the gift city in Gujarat is one classic example. And if you notice, friends, in your even in our income tax as well, loads of benefits have been given to securities or instruments which get listed in stock exchanges in IFSC. Now, what is the current proposal which RBI has come? In keeping in tune with the recommendations and also considering the volatility which Indian rupee might go through, the banks in India which operate in IFSC banking units are being allowed to participate in non-derivative market with effect from 1st of June 2020. So, and what this is likely to do, foreign banks branches outside India can deal in the offshore market and they would be outside the ambit of RBI. Similarly, overseas branches of Indian banks which were not allowed to deal in rupee derivatives in the offshore market. And by introducing rupee derivatives in IFSC and permitting IBUs, which is IFSC's banking units, to deal in such derivatives, a more level playing field can be provided to Indian banks to service non-residents. And this would also one of the moves to stabilize the volatility in Indian rupee. So let's try and understand from a practical standpoint how this works, because all these concepts are good. So if let's say the NDF price, the rupee derivatives price is 70 per USD for 1 million USD, and the settlement date is June 30th, 2020. And on the day before, and the fixing date, as we call it, which is one day before the settlement date, is June 29th, 2020. And which is the fixing rate is the RBI's reference rate on the fixing date. So we are going to take the rate as on 29th June. So the fixing rate on that day, on 29th June, is 71. Whereas when you got into the contract, it was at 70 rupees. So the seller here is going to make a 1 rupee profit. But the buyer, instead of delivering in rupee, shall settle the loss in USD. And if the buyer had taken delivery, he would have had to pay $1 million for the contract. Selling 70 million rupees in the market would have fetched him 9.85 lakhs, indicating a difference of 14,085. Instead of taking delivery of rupee, the buyer would pay a $14,000 as settlement for the contract. Now, if you try and understand this, friends, there is a contract between two parties. The underlying of that contract is your INR. The settlement of this contract does not happen in INR, it happens in USD. So even though someone has a rupee obligation or a dollar obligation which can be pegged to a rupee transaction or a value, he or it can enter into this contract without making the rupee volatile. So in our example, instead of selling 70 million and buying 70 million rupees, you only deal with the difference, and for that difference is settled in dollars. A tremendous reduction in the volatility, and more importantly, you also get into a natural hedge kind of a situation in our own currency without affecting your forward market obligations. Finally, this is what our RBI governor finished on. So COVID-19 is upon us, but this too shall pass. Thank you. And these were some of the thoughts which we thought would be relevant in this regard. Do you have any questions or observations? Please feel free. Looking forward to catching up with you once again sometime in the near future. Thank you.